Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. With a monster week of earnings around the corner and high flyers in the crypto and Mag 7 space, what is the rest of the market signaling? Is it still a resilience trade? How will releases of eco data, the likes of inflation this week, U.S. Treasury quarterly reporting, and the march towards the August 1st tariff deadline nudge markets to travel higher or take a pause? Giving us a view from the top today is Fidelity's head of global macro, Jurrien Timmer. His incredible charts and graphs could well help you stick handle the roads to investing through the second half of this year. Warm welcome to you, Jurrien, I think in Boston.
Yes, I am. Good morning.
Great to see you. It's very warm in Toronto. I'm sure the whole eastern seaboard is kind of the same weather situation, but it is summer, so.
Yes.
Let's
Can't
ask.
complain.
Yes.
It'll be winter soon enough. So.
No, don't complain about the warmth ever. Let's talk just a little bit about what this week actually sets us up for, because there is an awful lot. It could be, I mean, it's possible it's a different narrative by the end of the week with some earnings and data releases. But is there anything that you're going to watch especially closely, inflation side maybe?
Yes. So last week actually was pretty quiet, with the exception of Bitcoin going to about 118,000 and Nvidia breaching the $4 trillion mark, which is quite an accomplishment. I think Nvidia is now larger than the entire stock market capitalization of Germany. So there's that. But
wow,
relatively quiet. S&P was sort of barely changed. The 10-year yield was barely changed. The dollar was barely changed. But that could all be soon ending. And of course, we ended the week with more tariff headlines. And they barely move the needle anymore. I mean, the S&Ps are up 4 points now. And so that's a very stark contrast with, early April, when the tariff news would really be sending shockwaves to the market. So the market has desensitized, it seems. It's seen this movie now enough times that I guess it'll worry when they actually start to stick, and even then they could be unwound. So we'll see if the market is too naive here. But we do get earnings season starting this week. We have obviously the quarterly refunding announcement coming up. We have a bunch of econ data. The refunding announcement will be interesting because we'll see what kind of rabbit Scott Bessent can pull out of his hat in terms of how is he going to fund the $5 trillion big, beautiful bill. And as we're speaking, the 10-year yield is, 444. It's kind of edging back up to that yellow line in the sand of 450. And I think that still remains one of the key indicators to watch going forward. But so I think we're going to have a busy couple of weeks, and then it's August, and then August to October tends to be a seasonally weaker period, although, the caveat's always that's true all else being equal, and certainly nothing else is equal these days. So we'll see if that happens, but that's kind of how we're setting up here.
Can you just tell us a little bit more about what the refunding is, this quarterly report, and sort of the significance of what could be in it, for instance?
Yes. So when we go to slide 12, so obviously we have a very large gap between the debt that is being accumulated and the amount that the Fed is absorbing. So this chart shows the change in debt and the Fed's balance sheet since COVID. So of course we had a massive fiscal impulse during COVID, about $5+ trillion. And as you can see on the left hand of the chart, a lot of that was absorbed by the Fed. You could call it debt monetization, but it doesn't really matter what you're calling it. But the Treasury issued a lot of debt, and the Fed absorbed a lot of it. And then the Fed went into quantitative tightening mode. And then, of course, we had the debt ceiling, the first one back in 2023. And then in late 23, as the debt chicken started to come home to roost again, Janet Yellen, who was then the Secretary of the Treasury, pulled a rabbit out of her hat. And basically, the QRA came out, the quarterly refunding announcement, and it showed a lot of long bonds that were going to be issued. And of course, the bond market didn't like that. And so the yield pushed to 5%. And 5% is definitely a danger zone when you have a country with this much debt. When you get to 4.5 to 5, it's the yellow zone. 5 is definitely the red zone. And so Yellen responded to that movement very smartly, in my view. And she said, okay, you know what? Forget about that. We're going to issue them mostly as T-bills and not as bonds. And she could do that because there were very few bills issued at that time because of that debt ceiling sort of fiscal cliff. And that lack of T-bill issuance caused money market funds, including ours, to use the reverse repo program at the Fed. So there was over $2 trillion worth of repos sitting at the Fed at that time. So that was very low-hanging fruit for Yellen to say, you know what, we'll just issue bills and the money will flow out of repos into bills, and meanwhile we don't have to issue a lot of long bonds, and so everybody wins. And that happened basically. Now, however, what is Scott Bessent going to do? The reverse repo program is all but depleted, so there's no low-hanging fruit there. We have now a second $5 trillion, helicopter drop in addition to the first 5 years ago. So now we're in round two of sort of the fiscal dominance era, and the Treasury could fund all of it at the short end and just issue T-bills and no long bonds, and just roll them over, consistently. But there is a big increase, so someone has to be buying that, and whether they can regulate the banks into doing that through the supplemental liquidity ratio, or maybe they're counting on stable coins to be backed by Treasury bills. It's not clear what exactly the Treasury can do here, because there is no low-hanging fruit right now in terms of who's going to buy the debt if it's not the Treasury, if it's not the Fed, and it's not the Bank of Japan, it's not the Bank of China. Someone's going to have to buy it, and if they don't, it would require the term premium to go up, right?
Right.
If there's no buyers for market, the valuation has to be marked down. And I think that's, ultimately what could be driving the Treasury yield to 4.5 or above. So that's kind of the math, and that's coming up in the next few weeks.
Okay, that's fascinating. And then, as you mentioned, we have earnings. We've got everything else this week. Let's begin a little bit with just going through the period of taking a look at the S&P, which you showed us last week. I think you also said then there were lots of good reasons to buy. It was a good-looking chart. I don't know, I guess we're sort of wondering what's swirling around that. But the idea is the trend is up. There's a wall of worry. It's being climbed. And many things look good when you look at the charts.
Yeah, so let's go to slide 2. And so whenever things are murky and there's a lot of different cross currents, and we certainly have them, right? I mean, tariffs could hurt earnings, but the big beautiful bill can help earnings. And so, well, which one is it going to be? I do think there is some upside to earnings because they did get marked down in April and May, and the tariffs really haven't materialized in a big way. And in the meantime, the dollar's down and the market has rallied. So my guess is that the markdowns in earnings a few months ago will get unmarked down, or we'll see them. We'll see that strength appear back into the earnings numbers starting this week and the coming weeks. But again, here's the S&P weekly chart. Trend is up. The market is above its trend line. It's making new highs. Breadth is okay. It's not great, but it's okay. And so the market has momentum, and momentum often begets more momentum. And so that's a pretty good story. And again, you look at that yellow band in the top, and you're just like, okay, do you want to be long or short this? Well, generally, you want to be long things that are going up and have good momentum. But now, if we take that same chart and we go to slide 6, and you ask the same question, okay, that yellow band, do you want to be long or short? Well, on its own, you probably want to be long. But then you look at the valuation below it, and the price to free cash flow ratio is at really nosebleed levels. Maybe the answer changes then, because starting points matter, right? If you're starting an investment program at a 30 PE, your hurdle rate is really high as opposed to starting it at a 10 PE. And so does the bottom panel change the answer of the top panel? And it may very well, or it certainly would give someone pause to say, well, okay, maybe I don't want to blindly just pile into this, because you're paying a lot for every dollar of earnings. And then I'll just add slide 22, which I think is interesting. So we've talked about the S&P. One of the really bullish things right now is actually that this is a global rally now. And again,
Right.
about a month ago, I thought the bull market was over. That clearly was incorrect. And so so far things still look okay. And so this is the MSCI ACWI ex-US, both in dollar terms, which is the black line, and in local currency terms. And in both terms, the trend is up and the market's in good shape and breadth is in good shape. So there is not a lot not to like other than the valuation that we have to pay in order to play. And that, of course, that valuation argument is not an issue for outside the US because the ex-US index is trading at about 14 and a half times earnings as opposed to 23 times earnings for the S&P.
Even though Europe has had actually quite a run, I mean, it has been that value story for such a long time and then got swept off its feet to an extent through the beginning of this year and has had quite a rally through. I guess the question with Europe as part of that ACWI is how long is the run?
Yeah, and it's interesting, I was in Europe for a couple of weeks ago, and we've talked about that trip. And the general sense is that, okay, I get that the US might be becoming less supreme or less hegemonic, and that the cleanest dirty shirt is not as clean as it used to be, and it's now as dirty as the other dirty shirts in terms of like the fiscal backdrop. And at the same time, the US is expensive, and the rest of the world is cheap. But having said all that, I look around, and I'm speaking on behalf of these investors. I look around in Europe, and I can't really get that excited about anything. And in Germany, the institutions I met with are like, yeah, we have our version of the big beautiful bill here with the
Sure.
the NATO spending at 5%, but it's like it's not enough. It's going to take too long. It's all going to be done by the government, not the private sector. So the sense is still like, yeah, I can see why we shouldn't be overweight the U.S. But then what do we do? We go to Europe, Japan, and my answer there. And by the way, let's pull up slide 29, which is a new chart that shows the difference between the IFA, so not just Europe, but IFA, so
Yeah.
developed international. The green line shows IFA in dollar terms and in local terms. So generally, all these MSCI indices are reported in U.S. dollar terms. So it's interesting that the two green lines are almost identical. So
Wow, look at
for
that.
IFA, there is not as much of a currency dimension to investing there, either on a hedge basis or not. And you can see it's lagged behind the US for all the reasons that we know, but that was a fairly recent thing. But what we're seeing here in the bottom are momentum curves against the all country world. And you can see a clear shift in momentum towards international and away from US. So my sense is the rotation out of the US will have more to do with the value side, like the yield side, the income side of investing in equities than the capital gain side. So
That's
that's
really
kind of your
interesting.
growth to value argument.
Yeah.
So I think if you're going abroad and you're buying, European banks or what have you, you're really just you're getting that income. You're playing for the income. You're not playing for the capital gains. And so that's my sense. But seeing we're talking about international, let's just add slide 28 to that. And I just want to show you the contrast to EM
Mm.
versus IFA. So this is the same chart, but showing EM, local currency versus US dollar base. So US is the solid blue, local currency is the dotted. And look
Wow.
at the difference that makes in terms of whether you're
Amazing.
buying local or dollar. So night and day between
Night and
EM and
day.
IFA. And I don't know if that changes the math for investors today, but it shows you that currency plays a much, much bigger role for emerging markets.
That is completely fascinating. I mean, currency seems to be one of the massive themes of this year. And the other thing that you were just speaking about is taking a look at the yield as just broadly. Does the world just want yield investment? Do investors want yield more than they want at this point um, capital gains? I'm sorry, not capital gains, like growth of
Yeah.
the actual
I
stocks.
mean,
Is that where we
investors
are?
always want growth, obviously, and the growth has been available in
Sure.
the U.S., not really anywhere else. Were that to someday change, like as the secular trend sort of crests, and it certainly isn't doing it yet, but if that were to happen in the coming couple of years, either because rates are rising or inflation is stubborn or what have you, um, at that point, all of these value plays are going to look really attractive, right? Because then if you're getting a 1% dividend yield in the US and no real capital gains, and you can get like a 7% yield for a European bank, that then it becomes attractive. Right now, the opportunity cost is high for
Too
not
big.
being in growth, but that may very well change someday.
Can I ask you about the copper rejig that seems to be going on right now? Taking a look at where there is an abundance at this point because of imports into the U.S. essentially, and there's a rejig of the markets going on. What are we to make of this?
Yeah, the copper story is strange because there's only so many copper mines, and obviously it's a very capital intensive industry, and so slapping tariffs on copper, I don't know how much sense that makes, right? You're not slapping it on little widgets that could be made either in China or Vietnam or in, Nebraska.
Right.
Copper is a totally different story, even different from oil. Like that can be produced domestically. So I'm not sure what that's about, but my guess is that will not last. And so the commodity space in general, I think, is really interesting. Of course, we've unpacked gold a lot. I still think commodities in general, and I don't have the chart here, are in a super cycle. But commodities are difficult because when they work really well, but most of the time
They don't.
they
Yeah.
don't. So yeah. I
Um,
mean, if you go back 100 years, right, and you add commodities on an efficient frontier type of chart where you have the volatility on the horizontal axis and the CAGR, the return on the vertical, over the very long term, commodities generate the inflation rate as their return, which kind of makes sense, right? But they have a volatility like an EM equity, like a 25 vol. So you would never buy that as a strategic allocation, but more tactically and cyclically, there are times when commodities wake up, they really wake up.
yeah, it's interesting. I mean, will this discussion of copper wake something up? Do you think?
I think copper is kind of like gold, where it's just it's just hard to get more copper. Like it
Yeah.
takes forever to mine this stuff. It's very expensive. So my guess is that maybe the president was throwing spaghetti up on the wall to see what would stick. But that to me is not low hanging fruit on the on the
Right.
on the
Okay.
tariff agenda.
You have just a slew of questions coming in, so let's put some of these to you if you don't mind. You
Yeah.
touched on this. How do you view crypto's role in portfolios today? You've talked about this before. It's very interesting in light of what's going on with crypto just in the last sort of 48 hours, 72 hours.
Yes, for sure. Yeah, let's go to slide 15. We have talked about this a lot, and that's part of my theme of, the 60/40 being replaced by the 60/20/20. So, and just to unpack that, 60/40, of course, historically was the two was one-stop shopping, right? You buy some equities and then you add bonds, which would give you an income stream while also protecting you from drawdowns in the equity markets. Then that insurance policy of bonds during the zero interest rate days became very expensive insurance because in 2018, 19, 20, the real rate on bonds became negative. So now it was an insurance policy that you really had to pay for in the hopes of getting some diversification. Then, of course, COVID happened, 2022, rates rise, and bonds got repriced from 1% to 5%, which, of course, produced enormous losses for bondholders, while also adding insult to injury that they didn't protect from equities. The bonds actually caused the equity drawdown in 2022. So now, fast forward 2025, bonds are viable. The income is back in fixed income, right? Bonds are yielding four
Right.
and a half ish. Inflation tips break evens are about 2.5. The PCE is at 2.7. So you're getting a positive real yield. but the correlation has not returned back to negative against equities. So my sense is that the 60/40 needs to be rethought, and I would take some exposure out of the 40, maybe 10 or maybe 20. That's why I have a 60/20/20, and put that 20 in other stuff that is uncorrelated to equities as well as uncorrelated to bonds. And so gold is at the top of the list for me. Gold does very well when bonds do not. Bitcoin is along for the ride, and I only really look at Bitcoin, not at the other cryptos, because I think Bitcoin is a aspirational store of value, and the other tokens are not necessarily that, which doesn't mean that they don't have value, but they're just not in that same category. And then I've got things like, liquid alts and cash like strategies and commodities and tips and things like that. So that's kind of how I think of Bitcoin, and whether it's 1% or 10%, that's obviously an individual decision. My sense is that gold and Bitcoin together are are the hard money sort of basket, if you will. And actually, if we go to slide 18, I'll come back to the other one in a
Yep,
second.
sure.
You can see that a 4-to-1 ratio of gold to Bitcoin, to me, is the right direction of how to look at this. So a 4-to-1 ratio, because 4 units of gold has about the same volatility as 1 unit of Bitcoin. So that's why I have it that way. If you look at the returns in the top, they're almost the same. And if you look at the Sharpe ratios in the bottom, you can see that over the last few years, the Sharpe ratios have moved in opposite directions, which means that um, gold and Bitcoin, while they're players on the same team, they're different players playing at different times, and they're actually negatively correlated to each other, which is what
Interesting.
we want to see, right?
Yeah.
If you have a store of value bucket in your portfolio, you don't necessarily want them to do the same thing at the same time. So now Bitcoin has sort of taken the baton from gold, and that's because risk assets are doing well, and that helps Bitcoin more so than gold. And so that's kind of where that's at. And if you look at slide 15, just going back there for a moment, um, we see the writing on the wall, right? Treasury yields are at 4.5. We now have the second $5 trillion fiscal impulse that has to be funded. The administration doesn't want the dollar necessarily to play the role that it has in the past, so the dollar is eroding. The US is no longer the cleanest dirty shirt. It's now equally dirty. It's just now as dirty as all the other ones, more or less. And so you get to a point of, okay, who's going to finance the debt? Will the economy grow fast enough to be able to outpace the debt? And will the Fed eventually have to come back in either voluntarily or by force if, like Powell's term ends next year? We don't know who's going to replace him. And then you look at this chart and you see the Fed's balance sheet as a percent of GDP in the purple, the price of Bitcoin. And to me, that's not a coincidence. And so I think that's kind of what's playing here. And again, going to slide 13 for a moment, this is the chart I think I showed last week where it's important, and Scott Bessent is saying this all the time now, that the reason for the big beautiful bill is it's not obviously austerity, it's the opposite of that, but it's going to supercharge the US economy, and it's going to allow it to grow faster than the cost of its debt. And that has generally been the case over the decades. But if you look at the CBO projections for potential GDP growth in the blue, and if you assume that some kind of term premium will continue to be priced back into the treasury curve, you could see a scenario where the green line, the 10-year, is above the blue line. And that's when your debt becomes unsustainable. And at that point, you either need to grow faster or lower the cost of your debt. And I think that's what kind of gold and Bitcoin are sniffing out here, that some form of financial repression, like what the Bank of Japan has done in recent years and like what the US did back in the 40s, that will come back. And the escape valve for that is, of course, always the currency, right? It happened to the yen, the dollar. Do I have a dollar chart here somewhere? Dollar chart is on 20. And so you can control rates all you want, like Japan has done. but you can't necessarily control your currency, or you can't control them both at the same time. And so the dollar is much weaker than it really should be. And I think that that's a tell. And, we had a period back in the 60s of uh, concurrent fiscal and monetary easing. So that was the guns and butter days. And of course, that ended up breaking the Bretton Woods regime, and that led to a pretty big decline in the US dollar. And so I think that's kind of the story with Bitcoin and gold. And I see Bitcoin really as a player on that team.
It's fascinating. I think you mentioned if the dynamics that you just pointed out there are actually priced into other markets. Are the equity markets seeing this? Are bond markets seeing this?
Yeah, so that always, of course, is the question. Um, I think the equity market, um, so equities can rally no matter what, right? If earnings are growing, whether it's an illusion from inflation or money printing, or a rise in the money supply, or whether it's real earnings after inflation, the stock market can do very well, and actually can do extremely well at times of this kind of fiscal expansion. The bond market would not, unless it is again controlled, right? And what we see in the bond market, we've been in this range now, 4 to 4.5. Every time it goes to 4 or below, it's like a beach ball held underwater. It pops right back up. Like the yield doesn't belong there. It doesn't want to be there. And then when it gets to 4.5, 5, which I think seems to be the next move here, investors do show up. They buy bonds. But again, if the bond vigilantes end up not buying them, you could have a UK like moment. And at that point, the Fed has no choice but to step in just to maintain orderly markets. And then you add to that the tensions between Powell and Trump, and how is Powell going to serve out his term? And after his term as chair, will he stay on at the Fed, because his Fed term is 2 years longer than his chair term? And so, but none of that is good for the dollar. None of that is good for the term premium. So I think the bond market is struggling with that. And then the broader question that you ask is it priced in with gold and Bitcoin? And if we go to slide 19, on the one hand, you could say maybe this is all priced in, because when you look at the money supply, which is the gray line in the top, and the value of above ground gold plus Bitcoin in the purple, it tends to take market share from like fiat money when
Right.
fiat money is growing too fast. So if you think about this as a battle between soft money and hard money, right? Fiat currency, money supply versus gold and Bitcoin. So gold and Bitcoin are now 115% of M2, and so it's risen
Wow.
quite exponentially. So you could argue that, okay, this is all happening, but it's priced in. And I think there's some validity to that. I don't think we're quite there, because this is based on US money supply, and in the past, that was probably an appropriate proxy to use. But now, these days, this is really a global story, because the US certainly isn't the only one
Right.
with debt that might have to, inflate itself out of it. So the global money supply is 5 times bigger than the US money supply. And so if you apply this to a global landscape, maybe there's a lot more room to run here.
Okay, oh, that is so interesting to have it in the context of other countries around the world. As we started, there's eco data coming out, earnings, so the refunding announcement. What would you just have investors really keep an eye on over the course of the next week, really?
I think so. My guess is the earnings numbers will come in okay. If we go to slide 4, again, we had markdowns, right, in April and May. The growth rate for 2025 was marked down from 12% to 7. The tariffs haven't really materialized beyond the ones that were already being put in place. And meanwhile, we have the fiscal bill. We have a lower dollar. So I think there's plenty of room for earnings to surprise to the upside. Again, that's probably priced in at the PE level that we're at, right? 23 times expected earnings. So I don't know that better earnings are going to kickstart the bull market again. But I think that's a fairly likely scenario. And then it really, I would say, that yield, right? 444 right now. I think that's going to become increasingly important. And then how that plays with the dollar, which is at around 98 on the DXY. So those are probably the most important things I'm looking at.
Okay.
And then, of course, the quarterly refunding. But Scott Besson is a very, very smart man. And he knows what's at stake. Like, he's not, like a deer caught in a headlight, not having any idea what the markets are telling him. So he's very good at this. So I'm sure he will do something that he thinks will help the market stay calm.
Okay, we're going to be watching all of these with bated breath this week. Thank you for setting us up for this week with all your magnificent research, Jurrien Timmer. Great to see you. We'll see you next week.
Great. Thank you very much.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.